We do a roll call. I think we also.
Governor Martinez, Peter Frank,
Yes.
Secretary Rodriguez, Linda Eisen,
Present.
Tim Jennings.
Tim, you said you called.
Yeah, the phone is going, but I haven't heard connecting. Harold Lavender,
Here.
Treasurer Eichenberg,
Here.
Commissioner Dunn, Steve Rossi,
Present.
Scott Smart,
Here.
and Lynn Hoffman.
Present.
The agenda, are there any comments or suggestions on the agenda?
Motion to approve.
Thank you. All right, all in favor?
Aye.
All opposed, that passes. We'll be voted. Approval of the minutes of the meeting of August 28th.
Motion to approve.
Thank you, Linda. Any seconds? I'll second it. Any discussion? Okay, all in favor?
Aye.
Any opposed? All right. Right to the investment matters, and that's Linda.
Okay, well, I've got something that I really wanted to bring to the council's attention today. Our investment committee has, for the last several meetings, been discussing various matters regarding how we can most effectively serve our role as an oversight committee, both as an investment committee and as a council, in the selection of investment managers. And we do have some thoughts on that. Before I go into that, I want to preface it with, we are very aware and acknowledge that the asset allocation is responsible for over 95% of how our fund performs. So although investment manager selection is an important matter, the asset allocation, the strategic asset allocation, are more important decisions. So as we look to how can we better serve our function as an oversight committee and selection of investment managers, we look to our past to maybe see if we can learn some lessons from our history and kind of the bad old days. Well, in the bad old days, some of which we're still suffering from our legacy portfolio, our lesson learned is that we did not know why we were investing in something or how we were selecting those investment managers. Those were the problems that we had. And we need to give our council incredible credit for this, and the State Investment Office that has just done a super job. We have evolved a fantastic process for doing this. We have written investment policies. We have 3-year plans. We have annual plans. We have asset class summaries. We have pacing schedules. We have approved these. We know why we are investing in things, how much we are investing in them, and which sub-asset classes we are looking at this year. So we already know where these investments are coming from. We also have evolved a fantastic process of selecting the investment managers. I mean, even as recently as our last meeting where we approved the retention of Burgess as a data source to help us make sure we're selecting best-in-class, most suitable investment managers in the private asset class category. Our consultants use that, now our office uses that. So we have a fantastic process going where we have many checks and balances. We are using evidence-based public information to select these managers. We have it go through due process so many different ways. We've already told them by our studies what we want them to go looking for. So we have established a fantastic process. And so now we know why we are investing in something and how we select our managers. So therefore, we are feeling as an investment committee and hence as a council that our efforts should be focused on how those managers were selected, and being sure that as we look into all of our studies and policies, that they are answering, why are we investing in this? And sometimes I think that this is a matter of evolving. As we look at the specific funds and we meet with the managers, who are incredibly interesting people, passionate, and I love hearing about their funds. But in truth, we are an oversight group. We are not the investment manager here, and we are not investment offices. We are oversight offices. So therefore, we don't really need to know, why are we investing in infrastructure in Australia? What is the market like in real estate in Europe? What algorithms are we using for our factor-based large cap US markets? What is the unconstrained credit manager investing in? And do we have overlap in our other credit managers? These are not our duties. That's why we have investment professionals and we have an investment office and consultants. We are oversight. We look at, why are we investing and how did we pick them? So we, as an investment committee, are saying, every time a manager comes up, we're looking at, so how do they fit our policies, our strategies, our plans, our pacing schedule? Did you look at other managers? Why is this manager the manager you selected? What due diligence did you do? What are the terms of the investment? Are they competitive? Is there something unusual about the investment that we should be aware of? How does this fit with our other managers? These are the things that we will now be focusing on as we look at the investments at the investment committee level, and hence as we make suggestions to you. At this time, we believe that the executive summary prepared by our consultants and the memorandums prepared by our state investment office provide this information to both the committee and to us, and the committee does look in more detail at many of these things that are contained in those two documents. However, in our materials today, we have the full report by the consultants, and we do have the fund managers here. If you believe that the fund manager has something that you wish to inquire about the fund, that is your prerogative, but we as a committee are not exploring the details of the fund. We are looking at, why did you select that manager and how did they fit in our plan? So I wanted to let you know where we are coming from as an investment committee and what our recommendations are to you. Our recommendations mean we know that this fund does suit our purpose. We know why we're investing in it, and we know how they selected this manager. And that's what a recommendation will be. Also, we had it on our schedule for this last meeting that we were going to have a discussion on right-sizing the New Mexico private equity program. That was a matter that needed further study, and that will be on the agenda for our next meeting. If anybody wants to join in on us or anything on that. The investments that we looked at that are before the council today are all what we refer to as re-ups, meaning that they are the same manager, the same type of fund, that we've had a series of funds with the same purpose, with the same manager, and as those funds mature, and we need to reinvest that money in the same purpose, and they have looked at other managers and said, yes, this manager still is the best manager for this particular purpose. So we know the manager, we know the strategy, we know the funds, we've been in prior funds. And all of these have been approved for recommendation to the council by the investment committee.
Anybody want to comment or make any suggestions? What I'm just talking about is a subject I think that you will be bringing to us in the next 4 or 5 months, possibly.
Possibly
Some
even sooner.
recommendations. I think it all emanates from discussions we've had here about what the role is of the council, what the role of the committees are we spending our time most efficiently? I know many other members, Tim Meikenberg, for example, questioned why we were spending so much time interviewing managers on site here. And so these questions have been raised, and I think I appreciate your investigating and coming up with a set of recommendations eventually. And also, I think we've also looked at the legislative history and the statutes under which by which we are governed, and how that corresponds with what the fact we're doing.
Absolutely. I mean, we look at why the council was formed, and the statute is clear that we're an oversight committee. And we look at the skill set of the people sitting here on the council. We are not an investment firm. We are an oversight firm. Those are the skills that we bring. And those are the skills that the legislature wanted us to bring to the state permanent fund. So yes, and please, everybody, these are collaborative efforts. The members of the council and our state investment office have come an incredibly long way in the years to have all of these plans and strategies in place, to have these processes developed and honed. So this is very collaborative. Please contact me if you have any comments that you would like to give. Thank you.
All right, any discussion? Yes.
Well, just before we move on, I understand what you're saying there, Linda,
I'm
but
sorry, can you say that again?
I just,
Yeah.
before we move on,
Yeah.
because you want to go to the next part, which is good.
Right.
And I just want you to know there'll probably be a lengthy discussion on this. There is a difference in perspective. I understand what you're saying, but I don't think that necessarily is what everybody on the council opinion is. And so I just don't want it to be left at this point that, oh, everybody's hunky-dory with this. But I don't think that now is the time for the discussion until we have some sort of proposal from the investment committee. And then I think we need to reserve plenty of time to debate that, discuss it, and I think that needs probably more than one meeting. So anyway, I just let you know that's not, I think, an opinion that, or a position that all the council members support.
Okay, and please feel free to contact me if you want any further discussion.
Okay, very good. Thanks to the economies of course as well. Private equity, Vista Equity Partners, David.
I don't have a name tag, so I'm still David Lee, Director of Private Equity. Good morning, everyone. I'm joined obviously by Alan Walsh and Christine Pastori and David Breach of Vista Equity Partners. We are here to talk about Vista Equity Fund 7, which is a re-up. Vista is a large cap buyout strategy. It targets enterprise software, data, and tech-enabled solution companies with enterprise values from $750 million to $10 billion. Each investment check size is between $300 million and $1 billion. The investments will predominantly be in the U.S., with some European investments. Historically, more than 85% of the investments have been in the U.S. The target companies have mission-critical solutions, strong customer revenue retention, recurring revenue, and competitive positioning. Vista invests in these flagship funds, invests in 12 to 18 platform companies, and they certainly utilize add-on acquisitions. The target size of this fund is $12 billion, but the hard cap is $16 billion. And for perspective, Fund 5 was $6 billion, and Fund 6 was $11 billion. Vista has standardized its operational improvement and revenue growth initiatives into 110 Vista best practices. And Vista Consulting Group, which is The main advantage that this firm currently has over 115 professionals. They've grown this area rapidly. For perspective, there was 5 people in Vista Consulting Group in 2011. So Vista now has over 325 employees, over 110 investment professionals in the different platforms, which is this main flagship funds, foundation funds, endeavor fund, perennial fund, and a credit fund. They have 3 offices in Austin, San Francisco, Oakland, and Chicago. Vista also has displayed very low loss ratios, less than 1% of invested capital over the realized and unrealized since Fund 2. The ownership structure is Robert Smith, the chairman and CEO, and Brian Shep, our president, our co-founders. They own 65% of the management company of Vista. Dial Capital owns 28%. So what that means is Dial is 11% of the territory. And Vista Consulting Group is 100% owned by Mr. Robert Smith. The GP commitment in this case will be a minimum of 2%, and that will be in cash. Also want to talk about Vista's track record. It's very impressive. Fund 2 is a 2000 fund vintage, so that's effectively when their track record has started. All the funds are first and second quartile from 2 to 5. The worst fund, Fund 4, 2011 vintage, it has a 19% net IRR and 1.88 times the net multiple. So this is a large, high-quality firm with an excellent reputation, a specialized focus on software, and their funds continue to be in high demand, which is what is leading to some of these larger funds. We are in Fund 5 with a $100 million commitment, and Fund 6 with a $100 million commitment. For Fund 7, we're seeking a $50 million commitment. That's the 4th commitment in the private equity portfolio this year. And the reason we've stepped that back a little bit is not due to their excellent performance or any changes in the firm, but we have some concentration guidelines that we're trying to adhere to. So there have been some big exits so far this year. There are more to be announced, and that will help alleviate the situation, but we thought it was prudent at this point to go with 50 million. And with that, I'll turn it over to Alan for some comments.
Thank you, David, and I'll be brief because David presented a good summary, and then the folks to my right will tell you even more. But in terms of our report and our work, the key merits that we'll highlight for you are the favorable track record. They generated 18% net returns on their first, or higher on their first 4 funds, which we think is impressive. They've got a value-added strategy using the Vista best practices, as David mentioned. So it's not, the approach isn't contingent on buying a company and just selling it for a higher price. Software businesses are expensive, so they will pay sort of high headline prices, but they work through a lot of improvements to drive EBITDA and make those businesses better. They've got a long tenured and experienced team. The firm continues to be led by Robert Smith as chairman and CEO and Brian Shep as president. They've been there for 18 years and worked together previously at Goldman Sachs. And the firm hasn't had any senior level turnover on the investment team since 2009, which we also like. So same team, same strategy. And then, as David noted, they've got very deep operational resources through Vista Consulting Group, which they've grown significantly from 5 employees several years ago to over 100 today. In terms of the risks we identify, which are on page 7 of our report, the fund size, as you heard, is going to be larger than the prior fund. And this with Vista, and the concern when you see a significantly larger fund size is whether they can source and execute the deals needed to stay in the strategy that made them successful. They've proven that. They've been able to source larger transactions and, more importantly, sell those businesses, improve them and sell them for strong returns. Obviously, competition is intense and valuations are high. They tend to be fairly high all the time in software, but they're even higher now. But because of their value-added approach, they have the ability to improve EBITDA. So even if multiples contract, they've generated higher levels of EBITDA and generate more return. They continue to grow. Another concern is they continue to grow the business with new business lines, which presents the potential for conflicts of interest. They've had several of these in place for some time, and as we've seen, They've been able to manage those conflicts and set up policies and procedures to help mitigate anything. And the other risk you have with the business lines is the distraction of management, spreading their time across more things, but they've grown the team, they put people in charge of those sectors or those strategies, and still provided the oversight and leverage the platform. So those are our comments, and I know I went quick, but happy to take any questions, or we can turn it over to this team.
No other questions, or should we ask Dave and Christine?
I'd like to ask a question.
Why don't you speak to us for a few minutes, and then we'll move into questions.
I'd be happy to. So again, my name is David Breach. I'm the Chief Operating Officer of Vista. To my right is Christine Pastore, who runs our North American fundraising activities. Very pleased to be here today to talk to you about Vista. There was an excellent summary, so to perhaps add a little bit to that summary, when Vista was formed in 2000 by Robert and Brian, the fundamental investment thesis was, number one, that enterprise software is a very attractive area of the economy to invest in, and that number two, by bringing an operationally focused approach to investing, we could create a differentiated investment product that would get above average returns over a repeatable and sustained period of time. And if you look at the history of Vista over that 18-year period, what you would really observe is, number one, proving out the investment thesis that you can buy these companies and bring these operational improvements, but also scaling the infrastructure to be able to effectuate these operational changes at a much larger scale than when the firm was a very young firm in the early 2000s. So over the course of that time period, on our realized returns, we've been able to generate on a gross basis about a 3.4 times average rate of return and about a 39% internal rate of return, again, on a gross basis. When we buy a company and our underwriting standards, which I think to kind of the point about the growth in the firm and the growth in the size of our funds, the market that we play in has basically been growing about 16% a year since 2000. So if you looked at where we started as, call it $1 billion fund back in the day and just compounded it through today, you would look at a $12 or $13 billion fund just to have the same buying power in the marketplace that we had 20 years ago. But I think very importantly that when we underwrite a business, our investment committee has to believe that we can generate a minimum 3 times cash on cash return for our investors with what we call critical factors for success, which have to be things that we believe are under our control. So we do not underwrite to things that we don't control. We don't underwrite to the price of oil. We don't underwrite to the general economic conditions. We don't underwrite to merger and acquisition activity. So typically, over the course of our hold period on a business, we might do on average 3 to 4 add-on acquisitions where we're adding features, functionality, new products to sell into the installed customer base of our particular portfolio company. But notwithstanding that over the history of our firm, we've done 3 to 4 add-ons per platform acquisition, we assume at underwriting we will never do an add-on acquisition because, again, we can't control that factor. We don't know who will sell to us or not. So, we very much believe, and I think our returns have proven out that as we've grown bigger, we have not eroded our returns because we're still buying fundamentally the same types of companies that we bought 10 years ago, and we're underwriting to the exact same standards. We've just built, frankly, a machine that is able to do it at a larger scale than what we were able to do 10 or 15 years ago. I think the other important element of our strategy, in addition to having our consulting group, which is it's a captive consulting company that only works for Vista. It is not a source of profit generation for Vista. It's a business that is operated as a break-even entity we typically lose a little bit of money, which is fine, but we do not make money off our consulting arm. It just recovers costs. But in addition to that consulting arm, we have in excess of 100 executives within our portfolio companies that have worked with us more than once. So, one of the powers of our platform is that because we keep buying the same type of company over and over again, as we develop executives that really, distinguish themselves within our ecosystem, they're fully capable of being redeployed in new investments because they're fundamentally the same types of companies. And so we can offer, interesting career paths for these executives where, because we sold a company doesn't necessarily mean that they can't continue to be in the ecosystem. So as we look at, our operating partners, our investment partners, our consulting arm, our best practices, and then layer on all these executives that, have bought into the Vista way of doing business, it has just created a very powerful synergistic model that, again, has allowed us to do this with increasing frequency to a larger set of companies. I know that you've all received our presentation, and I'm sure have read it carefully. But the two slides that I would say are most indicative of what really our business model does is if in our presentation, if you look at slides 16 and 17, what this illustrates for you, and this is measured across our entire portfolio over the history of the firm. On average, when we buy a company, they have roughly a 16% EBITDA margin. By the time we exit in about 4.5 years, we've grown that EBITDA margin to roughly 40%. While at the same time, looking at slide 17, we've grown revenue to mid 30% from the date we acquired. So we're both growing the business, we're adding employees, while at the same time helping that company be more effective in its operations and decision making. And if we get those two things right, we see the growth and the value of these companies. And as we just announced a few days ago, one of our most recent transactions, I think, is just again indicative of the evolution of our model. We bought a company called Marketo 2 years ago. It was a public company that we took private. It's in the marketing automation software space. 2 years later, we just announced a deal to sell it to Adobe, which is a very large strategic software acquirer, where we've been able to generate for our investors, for you folks who are in Fund 5 and Fund 6, a return on a blended basis between the two funds of roughly 3 times on a $1.3 billion aggregate equity commitment. So as we've gone to these larger companies, we're still able to, it's anecdotal evidence, it's not scientific, but I think it's illustrative of our value creation methodologies. So I used to be a lawyer, so I can talk for a long time, because I used to get paid to talk. But I will pause and answer questions that anyone may have.
Oh, I didn't know, is Christine gonna make a presentation? I know we can always ask him how he did in high school, but at least stay out of that.
No, I don't know law school.
No, it's gonna be an interesting week. But was Christine gonna make a presentation?
No, I wasn't. I mean, I can speak to fundraising updates if there's
Well, that's
specific.
fine. I did have a couple questions.
Sure.
Staff, David, are you recommending, Alan, we're doing Class A, Class B? Which is the?
Class B.
Okay, and on the Fund 5 and 6, we put $100 million in each. This one you're recommending that we put 50. And my estimate is that we have been distributed about 35 million, is that correct? How much, and I was thinking we probably had a distribution of about 25 million in Fund 5 and about 10 million in Fund 6.
Those numbers are older.
Yes, so with regard to Fund 5, once we close Marketo, which we hope to close in the coming few weeks, we will have distributed almost 94% of your commitment in Fund 5, which I think just the Marketo piece is about 22 million for the state. With regard to Fund 6, which is a 2016 vintage fund, so typically you would think it's all being deployed, but because of the sale of Marketo, we will be distributing about 2.4 billion. So we will be, if my math is correct, roughly 25-26% distributed on Fund 6, notwithstanding that we're still in the deployment period.
And it's another 21.6 million.
Yeah,
So in
to the state.
aggregate, it's about 43.6 million.
Okay. And so,
And also, I would mention, they shared some projections with us, which includes stuff like Marketo. The projections they showed us based on June NAV, that they'll distribute 50% of NAV by the end of 2019. So roughly half of that NAV will be distributed by the end of next year, according to the projections. And frankly, they're based on what they're doing right now, they would have confidentially have another sales process as well. That so they're making, they're doing what they're achieving those projections. So roughly half of that NAV is going to come back in the next 18 months.
and what's the projected life of the fund again? Because it sounds like we're getting pretty quick turn.
So the fund has a 5-year investment period, 10-year life. What we have found as, frankly, we've just refined and gotten better at what we do. Our cash on cash returns have remained roughly similar. Again, we're underwriting to 3 times, so, we would expect the outcomes. We don't do 10 times deals, we do 3.5, 4 times deals. But our hold periods, I think are declining a little bit, so we're getting money back to you a little faster, so our IRRs are increasing, just because of the time value of money. So historically, our average hold period has been 4.7 years. Our more recent exits, it's been less than 3 years.
But fund term is 10.
Yeah, but it's a 10-year fund life with a 5-year commitment.
Okay, so I'm just trying to reconcile in my mind where we're going. Linda mentioned earlier that what we're trying to do here is just a re-up. And so as you've distributed funds, we're putting that back in. So it's probably pretty clear that you've distributed out of that $200 million that we originally gave you, you probably already paid back $50 million based on what you're saying. So the question then too is, as we have growth in the fund, if we're going to stay, in terms of our pacing model and our percentages, I'm curious as to why you're recommending only 50 million instead of another 100 million. If we're going to, consider that the fund is growing, we're getting a rapid payback or a quicker payback than expected. So I'm just trying to understand that recommendation.
No, absolutely. So the concentration guidelines are based on exposure. So that's a net asset value plus unfunded. One of the unique parts about Vista, and they're in a way a victim of their own success. As these companies do well, that NAV grows. If they're able to sell it, for instance, Fund 5, which we're in, it's a 2014 vintage, and Fund 6 is a 2016 vintage. So we haven't had those funds for very long, so even though they've been successful selling out of them, when they have a realization, a lot of times, because the time period hasn't been that long, we'll get that money back, but it'll be classified under recallable distribution, and therefore that unfunded will stay large. And that's why that exposure number doesn't move that much. As Chris has mentioned, we did have projections, which were probably slightly on the conservative side, but did account for some of the exits that are happening this year. And we still felt like 50 million was probably a pretty good number to size the commitment. We'll see if that ends up being fine, but we're trying to give ourselves a little bit of wiggle room. We're shooting right now a little bit above the guidelines, assuming that they're gonna realize quickly.
Part of it is that you're over now.
Yeah.
So even with the distributions, that'll come down closer to that 5% target, but, and they have raised funds more rapidly than in the past, some every sort of 3 years versus maybe others you see might be every 4 to 5.
So that makes a difference.
We've had discussion about this in the investment committee, and I think this is a good example of adherence to policy guidelines. So while we're very happy with the returns and performance of the fund, we're looking at our concentration guidelines and being improved.
Mr. Chair, can I put in a little bit of color?
Yeah, please.
On the next, yeah, so the pacing model right now is fairly aggressive because we're trying to get to a higher allocation. So we've been at 9, we're up to about 10, we're shooting for 11 in Land Grant 12, or 13 actually in Center Snack. So the pacing model as it is a little bit aggressive. Fund growth also has been higher than we expect over the long run. So the fund itself is growing, but that fund size feeds into the pacing model also. So we've got a kind of high fund growth, little bit of aggressive pacing model to try to get to a higher allocation. And, you know, we're sitting fairly late, we're just entering late cycle here, and, you know, these types of equity investments tend to disappoint our long-term expectations during a recession. So, yeah, I think that 50 is right in terms of the macro picture in addition to Dave's constraints on his case.
Part of the due diligence process was we realized, as Alan said, that we were slightly above the target at the time. So this new fund was coming in. We wanted to diligence the fund. We also wanted to get as much additional information as possible on what they were looking at for the next 6 to 18 months. We got that information, we took that into account, basically decided to compare.
Good.
All right, thank you. Any other questions?
Thank you, Mr. Chairman. I guess this is more for you, David. I was looking at your presentation and under risks. So my first question is more just informational for me, but what is about the average multiplier for tech companies over the last 5 to 10 years?
Well, so the last 5 to 10 years, it's the average is probably going to be percent because it really has jumped. I would say it's in the mid to high teens, particularly for software as a multiple. So this is the most expensive place, really, because these are the companies that are the most desirable. As Vista has mentioned, software has continued to become an increasingly large part of the environment right now. But in almost any industry that you can think of, you found usefulness of software for artificial intelligence. So this category will continue to grow. They found it much easier to borrow money also in software based on recurring revenue. So these multiples are the highest, but the most attractive companies, and just obviously we're looking for the most attractive companies.
You go on to talk about Dial. Is that how that's pronounced? Dial Capital?
Yes.
When I first looked at the performance of each one of the funds, you see a slight decrease as we get up into Fund 6. So when did Dial purchase, and do you think that had an impact on the performance as we see it going forward?
So the performance that you're referring to, that has more to do with the recency of the funds. I think you're looking at page 17 on diligence, and you're kind of looking at funds 3, 4, 5, and 6. They have all done pretty well. But Fund 5 is 2014 vintage, and Fund 6 is a 2016 vintage. So those have a lot more in terms of favorable effects. Fund 6 is still investing money. So as a result, with most of these buyout funds, it takes a little while to ramp up that performance. Probably 2 years is not indicative of where this fund will be. It's not $500 billion in the performance reports that they generate. They don't even bother putting funds that are 2 years or younger because that's a little too risky. So I would say that Fund 6 is off to a good start, but it's too early and it's apples to oranges to compare it to its other funds.
Do you think Dial had an impact on the funds? You took 28%.
Yeah, I think so the Dial investment is a non-voting, non-control minority investment that is intended. Dial's business model is to buy these GP stakes and to create a certain income stream with management fees and also with carry. To that extent, I think that's what they're interested in. They don't sit on investment committees. They don't have really any say over the investment process that Vista does, and I think that was pretty important that they stated that from the beginning. I think the Dial folks would say that also.
So Tim, were you present when we investigated making an investment in Dial?
Yes.
We actually had Dial and Vista.
Correct.
in
The
presenting
same
at the
day.
Interesting
Right
discussion.
behind each
I
other.
mean, the reason my question is more, is it just moving money back and forth among the partners? That's what I was trying to figure out. Because you say that Dial took out their share of interest, so that's not distributed going forward anymore, and so,
I mean, it's a legitimate,
I'm sure it's
item
legitimate, I'm
to
just
point
saying,
out that,
just trading hands.
yeah, the carry, about 11% of the carry, because 60% of it goes to, 40% goes to the investment team. So in essence, about 11% of the eventual carry does go to Dial. That's what they do. But, from our perspective, we'll continue to watch in the future. There's been a large interest in this area, not just from Dial, but from competitors that continue to try to buy these days and have successfully done so with a number of our investors. I think the jury's still out and we'll continue to watch it. But the most important thing, I think, in the beginning is to recognize the fact that they have not had any process of that. And, as I mentioned, in terms of senior investment professionals, they really has been very well.
If I may, Mr. Chairman, when you get to the executive summary, under strategy, and you talk about leveraging, possible leverage in the finance, is there a maximum leverage that you would use?
So it is certainly influenced by market conditions, and we certainly, importantly, in the history of this over 18 years, we've never had a loss on a controlled buyout, we've never missed an interest payment, we've never had a loan default in the history of the firm. So we put on what we believe are prudent amount of leverage in light of the businesses we buy are typically very high free cash flow businesses that also have no CapEx. So literally, 96, 97% of EBITDA is actually free cash flow that's available to either service debt, invest in the business, buy, do add-on acquisitions, what have you. So, in the current market conditions for larger transactions, you can find lenders that will let you borrow 7 times. 4 years ago, you could not find lenders that would let you borrow 7 times. It would be 5.5, 6 times. So and then in the smaller deals, it's going to be 5 times, 5.5 times right now. So it varies a little bit with cycles. I think also importantly, just to go back to your question earlier around multiples. We've done an analysis and we included it in our presentation that you might find interesting. But on slide 38 of our presentation, there's no correlation between what entry multiples we pay and what our investment returns are. So what we correlate very strongly to is the implementation of our operational improvement plan. When that implementation is going well, the business tracks as good as or better to our case. And if that implementation is not going well, then that's where we focus our resources to fix it. But, paying a quote high multiple for a very high quality company that's got a very well-positioned product in the marketplace. If you look at in the history of software, some of the worst deals ever done in software, not by us, but by some of our friends, were not high multiple deals. They were just bad companies, or products that had come out of favor in whatever industry vertical they were in. So we've continued to find businesses, even in this, kind of high price environment, that we are underwriting to 3 times our money on factors that we believe we control. And that's where our fundamental pricing discipline comes from, is that if we don't think we can get to 3 times our money, then we can't pay the price, we won't do the deal.
Under your fee credits that you have, and thank you, remember Ross and Preston, of course, going to be a Class A or B, so I couldn't figure that out either. So, I looked at that and thought that the fees could be substantial. Can you share with us on prior funds, what kind of fees? Because I thought you guys, across 10 firms, you could have $30 million in fees.
And you're referring to the Vista Consulting Group
Yeah.
fees versus transaction fees that you.
Yeah, everything kind of thrown in.
Well, so to be clear about a couple of things, so we, obviously, in our fund charge and management fee, we do not charge any transaction fees or.
And don't misunderstand, profit is what we're all for. So I don't mind you
Yeah.
making $30 million, I'm just
No.
trying to understand.
No, totally understand. So at the fund level, we do charge our management fee. We do not generally charge transaction fees or monitoring fees to our portfolio companies, which is, it's a widespread practice in private equity. And our agreement provides that if we did, there'd be 100% fee offset. Our Vista Consulting Group is a fee-for-service business that if a portfolio company utilizes those services, they generally get billed by the hour, the way a typical consulting firm would work. And we benchmark our rates to make sure that our rates for our consultants are at or below, market price for similar consultants. Our companies, if they don't use the services, don't pay for them. If they get a bill and they don't like the bill, they can argue about it with the consulting arm, and we really do try and run it as much like a consulting arm. But at the end of the day, that consulting business will not make a penny. There's not a dollar of profit that goes into the hands of Robert, Brian, myself, anyone else. It's merely trying to cover the costs that we pay to, employ all these consultants and get them office space and computers and all that good stuff.
And last thing I think I've got here is, on some of your, when we drop down to some of the other restrictions that we have, the way I looked at that, the question I guess I have is, does that mean that you can invest 10% of this in other funds?
In terms of investment,
That's on page 38, yeah. You see it there, Alan? I'm on page 38 of your, your page 12, my page 38. And it's got this little graph on it.
oh, here we go.
And that's my question there.
Yeah, so
Yes, so we do have the ability to make investments in debt securities. We have not historically done that. So if you looked at our funds to date, it's a provision that's been in our documents. Obviously, there could be certain market conditions where you decide, buying a company's debt isn't actually attractive. You can get equity returns in a distressed debt market, but we have not historically availed ourselves of that provision.
And this is a general provision also that we see in a number of other funds where you don't want your commitment being invested in, you don't want them to invest in another fund, not just their own, but someone else's where you're paying a management fee. There may be a situation, and I can't think of one off the top of my head, where Vista invests out of the fund into another investment that one of their funds is investing in, but there wouldn't be a management fee on it. So what this is trying to protect is them saying, geez, NCAP looks interesting, let's do some oil and gas and put some money into that fund.
I guess my last question, Mr. Chair, this events and the team, you guys like this investment?
We do, it is, and we intend to just stay with this manager.
Thank you, Mr. Chairman.
Brent, I have a question. Vista is cooperative with us on Colmar?
As far as I know, they have been.
Are you familiar with our Colmar process?
With they hired this fee compliance was, we've been asking for professional fees for managers.
Candidly, I assume that we are, otherwise if we weren't, I think I'd know about it. Usually I know when we're not cooperative, it's supposed when we are, so I believe that we are, but I'm happy to follow up on that after the meeting.
We expect the homeowner to cooperate with Colmar, which is somewhat invasive process that we are looking much more closely at the calculations carried out in calculations.
Sure.
And that Colmore is doing that for us through the also.
Yeah, I mean, we certainly fulfill those local reporting.
They were on the list of firms that responded to
Oh, okay.
all Palmer's requests.
The only parts that bubble us are the ones that have things for,
Okay.
so, we're not aware.
Okay, that's
aware
good.
of that,
I
right?
appreciate, we
This
appreciate
is not on the
that.
list.
Yes.
Are there any other questions?
Based on the recommendations of the Council Investment Committee, Private Equity Advisor Pavilion, SIC staff, and the general fiduciary oversight of RBK, I move that the State Investment Council approve up to $50 million commitment to Vista Equity Partners 7 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. Thank you. Yes, Lee?
I just question whether or not we should have the class in the amendment, in the motion.
The class. Oh.
Class A would be, so, kind of looking at legal over there. But is that important? Does it add, would it? Usually we don't have,
I don't think it's required. I think you make sure that you are in class B. So that's sufficient for your clarification. Most of our funds that our private market managers have varying class options. Obviously, if you disagree with the class A, class B, talk about it. But as long as there's a consensus that class B is what y'all want, I think it's been pretty clear in the discussion today that that's what we're doing.
you don't see any need to put it in the motion?
Absolutely not.
We've never done that before, we've had these issues arise. That's true. That's a good question. Okay.
Before we vote, Mr. Chairman, David did mention that if we don't like something, we can always argue with him, so I hope that you took that to heart.
Lawyer to lawyer. All right, I call, all in favor?
Aye.
Any opposed?
Show Tim voting yes.
Thank you, Tim. Glad to see you on board.
Been here for the whole time, just nobody ever said much.
All right, thank you very much.
Thank you very much. We appreciate your support.
Here, but I guess I was when you started, it was all fine.
That's correct. You didn't respond to the roll call, so we're not aware that you joined us.
Here, I didn't hear it.
All right. Okay, we're on to Townsend and Airmont. Did I pronounce that correctly? You did.
Yes.
Names keep changing.
Well, I'm sure we'll hear a little bit about
Okay.
Chairman Frank, members, I'm Paul Chapman. I'm Director of Real Estate Real Return, wearing my real estate hat this morning. We've got two very interesting commitments in front of you. The first one is for Airmont Capital Real Estate Fund 4. And you all know the Townsend team. Jack will be leading the Townsend presentation for that. Nathan Scheich has joined us. He flew in yesterday from London. And on 4 hours sleep, he's going to make a presentation about the fund offering. So I'm just going to start off with a couple of comments. Staff in Townsend recommend a commitment of up to €75 million to Airmont Capital Real Estate Fund 4, which is a European-focused, opportunistic, closed-end fund targeting net returns of 15%. Fund 4 is effectively oversubscribed. They've already had a first close of €1.642 billion. That was 24 investors in that. And we expect that Fund 4 will hit its cap of $2 billion at its final close in October. This is a re-up. We committed €50 million to Fund 2. We skipped Fund 3 just because of capacity issues. Fund 2, as I think you were alluding to, Chairman Frank, was then known as Perella Weinberg. Real Estate Fund 2, that was a 2013 commitment. The fund has generated a 16.2 net IRR. That's in domestic currency, in their currency, the US return, I'm sorry, that's our currency. US returns over the period of our investment swung around a little bit based on the relative value per dollar and euro. A few things to note. Our real estate portfolio now represents 9% of the overall fund against a target of 12%. That's a gap of about $700 million on an NAV basis. So the pacing model is designed to close that gap over the next 3 to 5 years. In terms of pacing activity for 2018, we have closed $240 million, which was our pacing target. So as a result, we're effectively, theoretically out of capital for 2018. We're viewing these as 2019 commitments because we don't expect capital to be drawn or any material capital to be drawn for either of these funds that were presented today until 2019. The proposed investment in Airmont is consistent with the proposed or the approved 2018 structure study, where we propose to increase investment to European real estate from a current level of 9.1% on an NAV basis to 15%. Airmont has produced top quartile returns in all 3 predecessor funds, and they've been in the top half in terms of multiple on capital. They achieve these returns by focusing on high-quality properties in Europe's most prominent, primarily Western European cities. They add value by resolving complexity, buying distress and selling as core, identifying and capitalizing on operational platforms, and executing on high conviction secular and demographic shifts. And you'll hear some of that from the team. Airmont is independently owned by its management team, and its partners have committed 200 million euros to this fund, which shows very strong alignment in our mind. They've shown very good underwriting discipline. They generally use fairly low leverage, and they carefully evaluate downside when they are considering investments. In terms of compliance, this complies with the real estate sub-allocation ranges in terms of manager exposure and other limits that we have in the portfolio. So with that, I'll turn it over to Jack.
Sure. Great. Good morning, everyone. Just a couple of highlights and just to expand on some of the comments that Paul made with regards to Perella Weinberg. So the name is now Airmont. This is the first fund under the Airmont name. However, they did become a fully independent firm in Fund 3. However, they kept the name Perella Weinberg at that time. So although they are now under Airmont, the last 2 funds, this one included, are under a fully independent organization. In addition to that, just to highlight on the capital pacing slightly, as Paul mentioned, we are looking at this as a 2019 commitment. The reality is that when we think about the attractiveness of opportunities, we do need to be mindful of the capital raising environment. Both staff and Townsend believe both this fund and Asana to be attractive. Simply as the calendar falls, if we were to wait a couple more months, we would miss both of these. And so that's why we are here before you this morning for both of those commitments. Paul mentioned about the strategy, so I'm not going to dig into that too much here. We are recommending a commitment of up to 75 million euros for this particular investment this morning. Briefly highlighting the track record, the strategy, as well as the overall platform are 3 of the primary things that we find quite compelling about this investment. Paul did highlight on performance. All 3 prior funds are in the top quartile and expected to hit their targeted returns. Across all 3 funds, they have not lost capital on any deals. The lowest returning investment is a 9% gross IRR, and that's actually on a loan platform. We mentioned already the performance of your prior investment in Fund 2. It is absolutely moving in line with expectations. We did skip Fund 3, as Paul mentioned, timing somewhat, but also the fact that Fund 3, we had made our investment in Fund 2, and there were limited realizations at that point. So when we were looking at Fund 3, we thought, let's continue the evaluation of this manager as well, and thus they continue to perform exceedingly well, and thus why we are back here this morning for approval for Fund 4. We mentioned the independent experience platform as well as the alignment here. We find it very a strong competitive advantage that they are now privately owned, strictly by the partners. The entirety of their revenue stream does come from this opportunistic strategy.
many of their peers are involved in potential core vehicle or value vehicle or an opportunistic vehicle. They are 100% dedicated to the opportunistic strategy, and thus all of their efforts are focused in this level of risk return. The carried interest is now broadly allocated across the partners, which we find also compelling, and the strong co-investment up to 20 million euros coming from the team in this case. And the last point that I would make is, it is important, is that many of their peers, when they come back for subsequent funds, really are raising a significant amount of additional capital, sometimes 2 times what they were raising previously. In this case, Airmont is not raising a significant amount of additional capital. They believe that they can invest this amount of capital within this market environment and in the time frame that they are allotted to invest that capital over an investment period. So we also find that quite compelling. The strategy overall, we think is timely for the European market. What are we looking for right now? Real estate across the globe is highly valued, as we've heard from private equity before, a very similar situation. So when we're looking for strategies at this point in the cycle, we really want to focus on managers that can drive NOI and create the value. That's absolutely what we believe Airmont can do in this case, and certainly their track record does prove that they have been able to do that. As an aside from that, they also focus on downside protection. They look to where they are investing, and they want to think about the exit after they have created the value. So investing in predominantly Western countries and Western primary cities, as well as the best assets in those markets, does become very attractive at the exit for other core institutional buyers that are looking to ultimately acquire those assets. We've highlighted a number of issues and concerns in the document. Just to briefly highlight, the one primary one that we really want to get our hands around this time is key man risk with Leon Bressler, who at this point is likely in the later stages of his career. You can see from the document that they have been highly focused on succession planning, and we wanted to ensure that was taking place. At this point, Leon has reduced his equity exposure to less than 50% of the firm and moved that equity into the 4 remaining partners. Additionally, the key man clause has been expanded to include all of those folks that have now been working together for over 10 years. So we do think that succession planning has been taking place, and less reliance strictly on Leon is taking place in the execution of these funds. At his age, our expectation would be that he would certainly be involved through the investment period, which is critical to moving this fund forward, and likely through the term of the fund, but absolutely over the next 3 to 4 years, he will maintain his involvement, which we certainly want to see. So with that said, we do gain comfort in what is taking place at Airmont, and the fact that Nathan and others have continued to work together under Leon, but also together in their own right for this period. So with that, I'm going to pass the presentation over to Nathan to walk through his prepared remarks, and we're happy to answer any questions along the way. I know, Lee, that you wanted to hit on a little bit of Brexit, and Nathan's certainly going to provide some comments as well.
Thank you for those 2 great introductions. I should start by saying we're very proud to have the existing partnership with you all, and are certainly grateful for the opportunity to hopefully continue that today. As Paul and Jack noted, we've been around now for about 11 years. We launched our business in 2007. We were associated with a firm called Pearl Weinberg Partners at the time. However, the group of us that became independent in 2015 remains the same people who were managing, investing, and operating the prior funds when we were associated with that firm. So this change in the independent status, the change in the name, and so on. At the end of the day, it's the same people since day one through to today, inclusive of the five partners who own the business now, who've been together for over 10 years on average. Another key point that was mentioned is throughout that period, we've been focused exclusively on one strategy, which is pan-European opportunistic. We do that deliberately. We think that's the best way to maintain a very coherent investment culture and a focus on a very specific type of investment profile. I think when we look at our business, what we believe makes us unique is really the operational expertise that we have, and how we use that to have a very deliberate impact on the value creation of our investments. We're not trying to invest in market cycles. We're not trying to play cap rate compression games. We're, as the prior manager in the private equity space said, we're similarly not trying to bet on factors that we don't control. Rather, we invest in situations where through a lot of hardcore real estate and operational work, we can essentially improve the income profile of the assets and businesses we own, and transfer them from one category of quality to another, and therefore render them highly attractive to institutional investors on our exit. We invest primarily in two categories, one being direct investments in assets. It was noted that we focus on the key major cities of Western Europe, so the asset strategy is very much an urban strategy, and quite simply the objective is almost always to through renovations, refurbishments, redevelopment, change of use, and on a limited basis development projects to basically create a leading prime asset at a top location in a great city. Our primary cities have historically been cities like Paris, Berlin, Frankfurt, London historically, we'll talk about what that means today, and then the Brexit environment, Barcelona, Lisbon, and so on. So really 8 to 10 cities where we believe the growth profile of the cities are the most compelling. The evolution of those cities, whether due to sociological, demographic, and other factors, provides a number of compelling opportunities. The second category includes investments in operating platforms or corporate investments. And there we look for a few features. Number one, we look for sectors where we can observe high quality and compelling fundamentals today, which is basically a fancy way of saying a sector where we see a lot of demand for a type of real estate that's in limited supply. Often linked to that dynamic, these are sectors where either you don't have yet a leading business in the space, or there are 1 or 2 businesses there, and either we have the opportunity to create a market leader or to buy one and grow it. And linked to that, there are often sectors where if you are able to achieve that outcome, you can often benefit from very high barriers to competition, which adds to the quality profile of the business. And finally, as a real estate investor, we only do this in sectors where fundamentally the value of those businesses, their focus is in the real estate and a certain type of real estate, and where the real estate itself is highly operational, so that it makes sense to own it through an integrated operating platform as opposed to owning it independently. One great example of what we're doing today in that space is in the student housing sector, where we have, since 2014, been developing what we believe is now the leading student housing business in continental Europe. Over 3 or 4 years, we've grown it from 3 assets in the Netherlands to some 20 assets and projects in 16 cities across continental Europe. We should be at about 15,000 rooms relatively soon, with a lot of growth profile ahead of us. So that's an example of a type of operating company that at the end of the day is very much linked to the real estate, but also has a major corporate dimension. We've also grown the operations at the top level from about 30 people to around 150 people. So we also spend a lot of time focusing on how the company should be structured, managed, and operated. In terms of what this strategy looks like, as it was noted, the financial performance has been very consistent across the funds and across the deals. If you look back over the 10-year period, we have generated a net 18% IRR to our LPs. That's inclusive of all the capital calls and distributions successively through those 3 funds and the latest audited NAV figures. At the individual fund level, Fund 1 was a 1.2 billion euro fund raised in 2007. That is 100% realized, so maybe some of the realizations Jack was referring to. We delivered a net 15% IRR with that fund despite the 2007 vintage. Funds 2 and 3 were successfully 1.3 and 1.5 billion euros. A number of realizations across those funds, and I would say importantly, a very late stage in the business plans for most investments, meaning over the next 2 to 3 years, we should have a very significant wave of realizations across those funds. With Fund 4, we're not trying to really change anything. We had an official target of 1.6 billion euros. We will maintain a hard cap of 2 billion euros, which we expect to hit in late October. And as Jack noted, we selected those figures despite the temptation to more dramatically grow the size, because we believe it's exceptionally important to be disciplined in how we make investments, but it's equally important to be disciplined in fundraising and to make sure we have a scale of capital that's consistent with what we view as the market opportunity, but also with the investment culture we've developed and the size of our team. Maybe to conclude on the concept of team, obviously there's no magic recipe in what we do. I think the key ingredients are a very specific investment culture that we've developed over 10 years together, and a very high quality group of skilled professionals. Many of whom have been with us for a long time, the partners for over 10 years, but also a deep bench behind the partners of individuals who've had a major personal impact on the positive performance we've had over the years. And in terms of how the team is organized, I think the traditional model in our sector is to have kind of an acquisitions team and a separate asset management team, where usually there's a handoff in between. We look at the post-acquisition phase of our investments, given the operational expertise nature that we pursue, as equally important. So we have an integrated approach. We have one team. Everybody works on all the phases, let's say, of the life cycle of the investment, We think that's a unique feature of how we operate and a critical element of our success, and is also a key ingredient to ensure we're always training and developing people in the best way. We're ensuring a consistency of that culture and a strengthening of that culture. And, Jack noted Leon Bress, our managing partner, who's aging. I will confirm his remarks that Leon is as committed as ever. Certainly the expectation is he remains as involved, as he has been, certainly throughout the investment period of his fund and beyond. But I think when we've been thinking about succession, it's not something we thought about yesterday. It's something we've been talking about since the beginning. And probably the most important element in that is really instituting a very strong investment culture with a great group of people who've been together for a long time. So I know there were some questions on Brexit and then perhaps the market opportunity, which I can touch upon unless somebody wants to drive this in a different direction first.
Well, yeah, why don't you respond on Brexit?
Sure. Okay, so I would say, we, like most people, don't know what's going to happen with Brexit. I think that the key issue today is that there's a lot of uncertainty. Most importantly, I think the UK government doesn't know exactly what's going to happen in the outcome. We're fortunate that if we look at our existing funds, we are very well positioned in the UK today. We didn't predict the outcome of the referendum, so it's not that we proactively positioned ourselves specifically for the Brexit referendum, but we have one office property left in our second fund, which you all are invested in, which is a relatively small position, which we'll exit shortly. And we have a larger investment in our third fund in a very differentiated operating business that is performing extremely well and will continue to perform well despite Brexit. It's more linked to other factors. But when we look at the landscape today, clearly that uncertainty makes it very difficult for a fund with a limited time horizon to make a very specific call, particularly in a market like London, which has been our main city that we focus on in the UK, which could potentially be extremely vulnerable to the various outcomes of Brexit. So the key point is we don't know what's going to happen. We're being extremely cautious. If you look at the worst case scenarios for the UK, obviously there could be a very negative impact from a real estate perspective in terms of pricing and liquidity, particularly over the medium term, even if things pick up over the longer term. So I think from our position, while we think for some types of investors with a much longer term horizon, maybe taking advantage of the depreciation of the sterling and so on, there could be interesting opportunities today. We're much more cautious, at least on the traditional types of real estate. That being said, we do still think the UK is a great country. There's a lot going for it. London is really a global city with a lot of amazing advantages that even in a slightly reduced form will remain compelling. So we do believe long term, regardless of the outcome, there will be opportunities to invest back in the UK. And even in the meantime, there might be other highly differentiated opportunities, probably more on the corporate side, where the dynamics affecting these businesses are much less vulnerable to or much less connected with the UK's integration with the EU than, let's say, traditional office assets.
Other question? Scott.
I'm curious about your student accommodation. Those tend to be off campus.
Yes, correct.
In the US, we're seeing declining enrollment and fewer students coming to campus. Is that different in your environment over there?
It's a great question and a very, I would say, astute observation. I would say there are a lot of differences in the European environment. The US and the UK student housing culture, let's say, has traditionally been one where students would leave home at the age of 18, go to universities, and be provided housing, usually on campus or in the periphery of the campus. In continental Europe, the sociological and demographic model was much more that students would live at home and go to local universities around their cities. So as a result, if you look back over the last few generations, in continental Europe, the dedicated purpose-built student housing market didn't really develop as it did in the US and as in the UK. And linked to that, you didn't have the same type of concentration of students living on the campuses. One of the reasons we were so attracted to this sector was after doing a lot of research, we realized that there was a major shift in how students are behaving in Europe over the last 20 years. Students are now much more mobile. You could say it's linked to the broader phenomenon worldwide. They're much more likely to travel to other cities and other universities across Europe, and therefore they need housing. At the same time, with a lesser impact, you've had a massive growth in international students coming from Asia and elsewhere, even from the US, to go to European universities, which has created demand for housing. So I would say a lot of this demand is being met off campus because the universities don't traditionally provide the same scale of housing as you had in the US. And since many of the universities, particularly where we focus, are in urban markets, frankly, it's not as easy for them to grow and scale to now absorb all of this new demand. So I would say a lot of the demand is going to off-campus housing, but that's not so much a change for Europe as it might look like from the US.
One of the things that's very interesting about their student housing strategy is that when students move out at the end of the spring semester, these, many of these or all of these are operated as hotels. So, in fact, when they had their investor meeting in Amsterdam, May, was it? November last year, that's where they put everybody out, was at one of their student hotel properties. So next time you go over to Amsterdam, if you're looking for a relatively inexpensive place to stay, you stay in a student hotel.
Well, that's significant because ours essentially sit empty for 3 months.
Yeah.
Otherwise, you have a different cohort of people too.
I would say, we spent a couple of years thinking about how we would invest in the space after really developing a thesis that presented a compelling, set of fundamentals. And, we didn't create this business from scratch. We found this business. It was, at the time we bought it in 2014, they had 3 projects in the Netherlands and about 30 people in the top co. But what we liked about the business was we had never seen anybody else, neither in the US, Asia, nor in Europe, operate a model like this, which makes a lot of sense once you think about it. But basically the concept is, as Paul said, the traditional issue with investing in student housing is what do you do in the summer? Either, the model in the UK is you charge students for 11 months, you get lower per month rates because they're not there the whole time, or you have models in other markets where the assets just sit empty, which create a lot of other issues in terms of let's say the income profile throughout the year. This business had created a hybrid model where they can transition between those two sectors. So I would say it's really 3. It's students who sign leases for 1 to 2 semesters, overnight hotel guests, and short-term accommodation where people are staying a few weeks to a couple of months. And that's usually, let's say, young professionals who are traveling the cities for projects, maybe parents, visiting professors, and so on. And what we loved about the model was primarily the flexibility in the summer, but also it meant that what this business demonstrated was they could bring the culture of a hospitality operator and the culture of a student housing operator into the same asset, which is not easy to do because they're typically very different businesses. They could do it extremely well, and it meant that also through the hospitality angle, they were providing a lot more services and a much higher quality product even to the students who were there than we typically get in student housing. So since we focus on international students, typically it's a bit of a higher income demographic than the local students. We are able to charge higher prices and get higher levels of rent, both from the students and also avail ourselves of the flexibility of that model. And finally, I would conclude, since our intention was always to use this as a platform to expand across Europe when nobody had really done that yet, we thought the flexibility of that model meant that this business would be much more adaptable to the local conditions of different markets than other more rigid student housing businesses that only focus on students. And some of our assets, even during the academic year, might have 30 or 40% of the room capacity in the short-term accommodation or hotel category, whereas others will be more like 80 to 90%. So that flexibility also means you're going to Paris or Florence or Madrid or Barcelona, Berlin, et cetera. All these markets have different conditions on the ground, they have different dynamics, different fundamentals, and I think the flexibility of the model proves a big advantage in being able to expand rapidly and ramp up the operations very quickly in these markets.
I'm guessing you're making some of these places pretty nice because there's a bunch of places I had to live in when I was in college. You wouldn't have wanted to spend the summer in.
Yeah, I would say that the cinder block prison that I lived in college would not work for our model. I think we based that. I would say so. The first thing we loved was the hybrid model. The second thing, which was this is not in a hierarchy, but great people. So a great founder with a great vision. And the third thing was a really very disciplined focus on the product quality. Not just making it look nice, but thinking a lot about space utilization, focusing a lot on major common areas. That means, by the way, we have much bigger assets to subsidize on from producing areas, typically 300 to 600 rooms, all with their own bathrooms and so on, single occupancy. So the physical quality had to be very high so that we could operate in sort of the, let's say, lower price point end of the lifestyle hotel segment while attracting students to what is a very unique product.
Tim Jennings, are you on the phone? Are you able to hear us?
Yes, I'm on the phone.
Great, okay, I just want to be sure you're still alive. All right, are there any other questions or subjects for discussion with this group?
Based on the recommendations of the Council Investment Committee, Real Estate Advisor Town, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve up to €75 million commitment to Airmont Capital Real Estate Fund 4, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. All right, any other questions, comments? All in favor? Aye. Any opposed? Kim, I think I gotta get, thank you. Unanimous approval. Thank you for coming from London.
Thank you all very much for your trust and support, and it's always a pleasure to come to Santa Fe, I have to say.
Take some commodities back with you.
That's what I'll be doing this afternoon. Thank you very much. Thank you for participating on the phone. I know it's difficult with a long speech.
Our next investment is the SIC Partners street level real estate. Yeah, Paul, is that you?
Yeah, that's me, and
Okay. Jack?
yeah. So, when we presented, Fund One, I think it was Sam, right, you, and Terry Brown, who's one of the partners in the firm. We have Jason Tompkins with us today, and Sam, to discuss, Asana Fund Two. And I think Seth Marcus is going to be handling the Townsend segment of this presentation. Staff in Townsend recommend up to $75 million commitment to Asana Partners Fund Two, U.S. retail value add closed-end fund targeting net returns of 11 to 13%. Fund Two, as with the Fairmont situation, is effectively oversubscribed. 5 investors participated in the first close last month with $240 million of commitments. Fund Two is expected to hit the $800 million card cap at its final close in October or early November. This is a re-up. New Mexico State Investment Council committed $75 million to Fund One in early 2017. Fund One has generated an 18.4% net IRR, which is really tricky to do during the J-curve period, but it demonstrates the success of the strategy and the need for the strategy. There's been no asset sales to validate the carrying values, but we know that Asana's got a very robust valuation process. These returns over the longer period are expected to trend down a little bit. Their business plan projection is now a 13.7% net IRR with a 2x multiple on capital. We discussed the pacing model. Again, this is going to be considered as a 2019 commitment. Same rationale, this capital is most likely to be drawn in 2019 and afterwards. In terms of rationale, New Mexico State Investment Council, when I came on board, I felt lucky that I walked into a portfolio that was already allocated to retail, which suited me fine. We've maintained that allocation, that under allocation relative to our benchmark. We're 16.7% against the benchmark of 19.7%. Within the retail space, there aren't a lot of opportunities. We've all read the disasters going on in malls around the country, except for the very top handful, 50 or so, that continue to do very well. Grocery-anchored centers have their own problems in terms of the introduction of Amazon and through Whole Foods, the impact that's going to have on the grocery-anchored space. The Asana strategy, on the other hand, is focused on a very niche market segment that is showing a lot of strength, walkable, experiential retail. I'm going to skip a little bit on some of the comments I had on the strategy because I bet Jason will touch on that. But typically what Asana does is they come into a market that they've identified that fit their screens, and then they do some sort of a largish acquisition in that market. And then they do a series of add-on investments that might be in the range of $1, $2, $3, $5 million a piece. So it's a very, very hands-on strategy. Then they implement a renovation and re-merchandising strategy to optimize the retail experience. And through their work and prior experience and while at Asana, they've developed some very critical relationships with some of the newest retail concepts that are really important to these urban environments. Names like Outdoor Voices, Warby Parker, Soul Cycle, Vineyard Vines, Whole Foods, Flower Child, Allbirds, most of which I've never heard of before. In terms of I've seen Compliance and due diligence, we've done, staff has done our typical due diligence. I attended the Asana LP and LPAC meeting for Fund One recently, toured many of their properties in various markets around the country. Very satisfied with the work they've done so far with their existing portfolio, with the team, with their reporting. So I'm a big fan of the strategy, and I'll turn it over to staff to discuss it from Challenge's perspective.
Thanks, Paul. And thanks again for the time today. I'll keep these comments relatively brief, given we have two of the lead managing partners here to present the fund itself. To reiterate a little bit on Paul's comments, this is a non-core value-add street retail investment that we're recommending a $75 million commitment to, follow on to a 2016 commitment of the same size. As Paul mentioned, that initial commitment is delivering 18% net return year to date. And really that's being delivered consistently quarter over quarter. We see 3 to 6% time-weighted returns. And while early in the fund life, how they've achieved this is really with significant markups really reflected with 88 new leases were signed. Occupancy has moved from 70% to 82%, and lease rates on average have been 25% above underwriting. So it's really executing exactly the strategy that they've presented. And maybe I'll just address one question that may come up. I'll address that up front. This is a pretty quick turnaround from the 2016 commitment into the follow-on fund. When Asana was raising Fund One just a couple of years ago, this was a new organization. And Townsend suggested and maybe pushed a little hard and forced them to raise a smaller fund than they could have, and that they would have liked to. We did this really to have them establish a team, build out the platform, show some performance results, establish a track record under this organization, although they've worked together under a prior organization, and then come back to market and really evaluate. And that's exactly precisely what they've done. The prior fund was $500 million, and now they're back out raising this fund two, targeting $600, but likely to be at the hard cap, as Paul mentioned. Asana does come with fee breaks outlined in our recommendation through both Townsend aggregation and year prior commitment, both reduce the fee. The gist of it, and there's a number of different comments in there, is that there's a big floor, 25 basis points that we anticipate Mexico to achieve. And that's through a combination of Townsend client aggregation as well as your prior commitment fund. As with Townsend's typical investment recommendations, we highlight a number of advantages in our recommendation. A retail specialist, a strong alignment against a privately owned organization. It does have an in-place network with strong prior performance, as well as some issues and concerns that we do think we should identify along the lines of a relatively new platform, which I and some additional new markets that they are exploring. I'm not going to go through each of these specifically, but happy to take any questions on those when there's time for that. The one thing I will mention, and Paul highlighted the portfolio construction side of why we're making this investment. So when we look at investment opportunities, Townsend does prefer to really mirror allocator commitments as well as operator commitments, depending on the property type, depending on the opportunity set. So this we would categorize as an operator commitment to a retail-focused fund. Prior in 2018, we made a number of allocator type commitments to KKR, to Almanac, where they have a more diversified, broad investor or broad strategy, and they can invest across property types, across segments, and in some cases across regions. And we like to mirror that with something like an Asana, who did a similar investment to Exeter in the industrial space. And these focused operators that tend to be lower fees, closer to the assets, and really can focus on a very targeted segment of the retail space. We do not, as we discussed on our investment committee call, we had our head of strategy, Prashant Tiwari, represent our view of the world. We do not like retail in the broad spectrum of invest in retail and buy anything. We have very specific opportunities in each of these property types, and street retail being one of them here. So with that said, I'll hand it over to both Jason and Sam to present the investment.
Great, thank you, Seth. And thank you, Paul. Good morning. My name is Jason Tompkins. I'm sitting beside me is Sam Judd. As Paul and Seth mentioned, we're two of the three founding managing partners of Asana Partners. Asana Partners is based in Charlotte, North Carolina, and today we're comprised of 16 women and 19 men who we believe are operating at an extraordinary level. We are honored to be here today. We take our fiduciary responsibility to this council as well as to your beneficiaries very seriously. In January, as Paul mentioned, January of 2017, both Sam and our third partner, Terry Brown, sat in this room and introduced you to our platform and to Fund One. As some of you may recall, we formed Asana Partners in September of 2015. Our goal was to create a high-performance, vertically integrated, retail real estate-focused investment management firm and create significant value for our institutional investors by pairing a very focused and differentiated investment strategy with extensive operating experience in the retail space. As Paul mentioned, Fund One was oversubscribed, and the final fund size was at our $500 million hard cap. Today, Fund One is approximately just over 90% deployed or reserved, with key neighborhood street retail and neighborhood center holdings in a number of dynamic urban neighborhoods, including Davis Square in Boston, Massachusetts, Old Town Alexandria in Washington, D.C., the South End neighborhood of Charlotte, East Atlanta neighborhood near the Beltline in Atlanta, Georgia, the Deep Ellum neighborhood in Dallas, Texas, and the Highland Park neighborhood in Los Angeles, just to name a few. As Seth mentioned, operationally, Fund One is performing well, and if anything, we're only seeing an acceleration from a performance perspective as we attract new and interesting retailers to these neighborhoods. For example, we've invested about a third of the planned redevelopment capital across this portfolio, and we plan to invest about $140 million of redevelopment capital across the Fund One portfolio. We have, as Seth mentioned, we've driven leased occupancy from about 70% on average at acquisition to 82% today, and we see a very clear path to being in the 90s over the next 12 to 18 months or so. Seth also mentioned this, but we are continuing to execute leases at a meaningful premium to our underwriting, currently blending to about 27% premium to our underwriting. So the portfolio is performing well, and retailers are consistently attracted to the demographically driven neighborhoods that we are investing in. We are on track to outperform the fund level targeted returns and multiples by a comfortable margin. And lastly, and perhaps most importantly, we believe that the projections that we use to reforecast the fund level returns are very conservative. And this portfolio, we believe, sets up very nicely for significant non-underwritten upside, which is also very important to us. At this point, I'm going to turn it over to Sam to talk a little bit more about the retail landscape and then Fund Two specifically.
Thanks, Jason. So I can say, certainly I sit here 2 years later with much more conviction on the strategy, seeing the results in Fund One, and seeing the market dynamics that we experience every day. We feel like there's a huge opportunity for Fund Two, and probably funds beyond that as well. The market dynamics, what do I mean by that? Despite the headlines, there are many successful retailers out there, growing, profitable, successful retailers. Some of the characteristics of those retailers, they either have or are developing sort of seamless physical and digital experience. So for the consumer, so you think about a Starbucks, for example, they've spent a lot of time on their app. I don't know if anybody has the Starbucks app, but you start to get that ingrained into your daily routine if you're going to Starbucks. They've done a nice job. There are countless others, but the universe of these retailers is made up of both these established bricks and mortar, like I said, Starbucks, and I can go through a number of other examples who are evolving to meet consumer demand for digital, really. And then also, probably the other half of that is retailers who were born online. Everyone thought, retail is going to be online and that's going to be the end of it. But what these retailers are finding is in order to grow and be successful and really be profitable, they're opening physical stores. So, example of that would be Warby Parker, who many of you are probably familiar with. They started out online to sort of challenge the established monopoly in the eyeglass market. And they started out by shipping out 5 pairs of glasses to everybody, and you could pick one and ship them back for free or pick none. They raised capital, started opening physical stores. They're on pace to have over 100 stores open this year. And they found that the the profitability goes up because people will go into the store and stop by, customer acquisition costs go down, they built the loyalty online, and now they're opening physical stores. So we have relationships with both of these retailers, the established retailers and new ones. Paul mentioned a number of them, but just some other examples of tenants that are really active that we have either executed leases with in Fund 1 or are in negotiations with Patagonia, Shake Shack, Blue Mercury, Trader Joe's. These are all just from legacy kind of traditional retailers you're familiar with to newer ones, and I could go on and on about them, but there's a lot of retailers who are growing. One of the things that they have in common, they're in a smaller footprint than some of your traditional bigger retailers. We're not buying 40,000 foot boxes. This is the average size of space in our portfolio is about 3,000 square feet. The locations of our retail are in walkable neighborhoods where most of the people that are accessing this property walk there or can walk there, to the nice side. And so that's just a differentiator between getting in your car and driving 20 minutes to a retail shopping center. On the investment front, we continue to believe we have a first mover advantage in this space. To our knowledge, we're the only really well capitalized group with a national platform who's investing in neighborhood street retail that's aggregating at scale and brings these retailer relationships across the country. When we sit down with Soul Cycle and do a portfolio review, we can talk about 12 different markets that they want to go into in Fund 1 and in Fund 2. And that's a powerful advantage versus local operators in these markets. Thinking about Fund 2, we have a pipeline that's greater than $600 million today. As Jason mentioned, we're about 90% committed in Fund 1. And so what that means is most of that pipeline is going to be immediately available for Fund 2. And we're pretty far along with some of these negotiations, so we'll have immediate traction in terms of deploying that investment. Fund 2's got an identical investment strategy. We'll be in some of the same MSAs and some new MSAs where we've been spending a lot of time over the last few years. So we're excited about that opportunity. First closing was in August, as Paul mentioned. We expect to wrap up the fundraise in the fourth quarter, and we do expect to hit our hard cap there. We can pause there and see if there are any questions.
Characteristically quiet.
Maybe for Paul, but I'm concerned that if I understand this one right, we'll have about 12.5% of the fund. And I know the policy allows us to have up to 25%. Given this sector, I'm a little iffy on what retail space to begin with. And I appreciate Sam addressing that, but it seems like we have a high percentage of a fund in a more risky, low-performing sector in general.
Well, we have $2 billion NAV, and our commitments to Asana will be 150. So we'll be sort of in the 7% range. So that, isn't unusual in terms of the exposures that we have in our real estate.
I thought this fund was 600.
We expect this fund to hit the $800 million hard cap in the first.
Oh, I see. You're talking about the size of
It's
the
just under 10%.
Yeah.
In this particular fund.
Yeah, I got you, I'm sorry. Yeah. So this strategy, I think, in the first fund, how many investors did you have in the first fund?
12.
So it was kind of a smaller number of investors. Fund 1 was sort of more, almost like a club structure. It was a very tough time at that time to talk to people institutional investors about retail, because everybody was worried about the mall space, everybody was worried about high street retail, people were worried about grocery anchored center space. But, I just saw, and confirmed by Townsend, just a really compelling opportunity that I think has played out. So, in these smaller funds, it's not unusual for us to be, that 15% low.
I'll also point out there are a couple of other $75 million investors. Fund 2 as well, about $100 million.
The largest investor will be at $100 million.
Okay. Other questions?
Any Brexit cards?
We're fully insulated.
Well, that's incredible. I can tell, this is almost one-off.
Based on the recommendations of the Council Investment Committee, Real Estate Advisor Townsend, SIC staff, and the general fiduciary oversight of RDK. I move that the State Investment Council approve up to a $75 million commitment to Asana Partners Fund 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, any other questions or commentary? All in favor?
Aye.
Any opposed? Three is a no, and Tim, you voted?
Yes.
Yes, thank you very much, Tim.
Thank you.
All right, thank you very much.
Thank you.
That's RDK, are you making any money?
We are, Mr. Chair. In fact, I was just noticing, we've got your July performance report book, page 316, is where we'll try to start. I was just noticing when the report came in a week or so ago, how steady the returns have been across this time frame. I mean, we are 7 to 8% clear out 10 years now on that. Just about every time frame. So this, this recovery and further rally and late stage bull market that began back in 2009 has just been real smooth, real steady for us, at least in terms of return generation. We talked last time a little bit about how the economy was performing very, very well today, well above our long run potential expectations. So potential growth in the economy is definitionally anyway, is growth in labor force and plus productivity improvements. We think that's around 2%. The second quarter, for the second quarter annualized at 4.2%. So more than a double over our long run expectations for economic growth here in the country, at least potential economic growth. So very much on the boil right now. A lot of that was due to the tax cuts that were implemented in 2018. Those actually generated about 16% improvement in corporate profits. But there was a 16% improvement in corporate profits. Most of that was the tax cut, we think, some from the underlying economy. Despite being fairly highly valued, the stock market was pretty glad to capitalize that. We're up almost 10% so far this year. Most of that, of course, on the earnings growth. It was really nice to see that too, because we run just a quick model that breaks performance of the stock market down into the four basic components of earnings growth, dividend yield, multiple expansion or contraction, and then share buybacks or other corporate activity. And for quarter after quarter there for a while, the return of the stock market was all about multiple expansion and share buybacks, which is really some dangerous return to chase because that can turn around on you fairly quickly. I mean, if you're starting from high multiples like we were. So this last quarter has been much better with your earnings growth. We expect third quarter, our model will still say the stock market's just capitalizing earnings, which is a good function of the market. But into this very strong economy, the Fed's been quite aggressive in normalizing rates. Now, we say normalizing instead of raising because rates were just way, way low compared to what the normal rate might be relative to inflation, relative to growth, the other basic factors. We're up to 2%. We're expecting a quarter point this month. I think a 2.25, and the market's got priced about 2/3 of a chance to see another one in December. So with inflation around 2 and rates as much as 250 by the end of the year, we think anything much further than that would move us into restrictive territory. I think the markets would interpret it as restrictive if we went 2.75 or 3% over the next year, which would have much different implications than this sort of move from 0 to roughly the rate of inflation. So we're keeping an eye on that in terms of potential effects on valuations and so forth. So on page 316 is the July numbers. Again, very steady performance. Let's actually start in that top right box if you wouldn't mind. You can see by non-core fixed income, -558, that's outside of your policy bounds. Now the policy just says if it gets outside of bounds, on the best efforts, basics goes back So we're not compelled to cover that in the short run. Same thing if we would have gone out to the upside, we would be compelled to sell to get it back in the short run, although there's policy that has a strong expectation that we'll keep it within the wickets there. That's really a short-term deviation for the September part, is that right? September 1st. For your September report, you'll see that fixed. We've moved the floating rate debt, the bank loans, and waterfall, which has a number of asset-backed type floating rate debt things, and a lot of student loans in that fund, from the real return portfolio to the non-core fixed portfolio. Really for a couple of reasons. One, that'll open some room for us. For real estate debt, some other types of infrastructure debt, and things like that. More associated with the assets that are in there. And that floating rate strategy will still stay with us. And it's been successful. Fed's been raising rates and we've been getting higher yields. That's how that portfolio is supposed to be. So that'll be fixed. That 3.42 is getting fairly close to the 4% limit we have on core fixed income. Bart's doing his best to we're doing our best to find places for Bart to get that money out and get to other investments. Capital calls have actually been pretty good. We had a lot of return in the private equity portfolio earlier this spring. That seems to slow down a little bit and start to get more capital in that market. And the real estate portfolio and real return portfolio have been consistent capital users over returns. So we're finding homes for the things that we need to reduce. One thing you'll notice is the U.S. equity line. Your targets during the current is 25.2 against the 24 target. We actually had that down to 24%. The stock market took a run back up to 25 we go. We've been fighting that battle, although it's a good one to have to fight for several years now. But we do expect if the S&P crosses 3,000 here, we'd really be interested in maybe reducing that number a little bit more. That'll be a trigger point for us to at least make a consideration there. So you could see some rebalancing closer or back down to that 24, maybe below, certainly towards your 20% long-term target. Severance tax just a little bit closer to its long-term targets. We tend to try not to trade these funds. That's expensive. It costs us money to move money around. Where we can, we trade units. That's free for us. But so you'll see differences between that and severance just because we really think hard before we pull the trigger and take market impact expenses and things like that. Because all that money we don't spend, we get down to the bottom line. We like that a lot. Just one more thing, or just one other thing I would point out on this report, Mr. Chairman, is most of our asset classes, well, if you look on page 318, under land grant total composites, on the difference line, fourth line down from the top, all positives straight across the 10-year number in terms of outperformance. Now that's in gross space. If you flip back later in the report, I think the 5 is just slightly under, but everything else is ahead. So good manager selection continuing to come through in this portfolio. And I think that was it. Let me flip over to Marcia Matias if they have a comment on this, and then I can circle back on the
Maybe just very briefly on 320, this is the IDP, the attribution, just to reiterate, this is a page that you really like to look at.
It's a Linda's point, right?
Yeah, it's a Linda's point. I think the blue bar, 7.9, you can see that out of the total return of 8.49, 93% over this time period did come from the strategic asset allocation. The other 3 buckets right below that in the top box are also positive, although I would argue that the yellow and the orange typically aren't strategic sources of value add. And then manager alpha is 43 basis points. The only other comment I think I'd make is on the bottom left, you can see that US large cap added 3.69%. That's nearly half the return, and it makes sense given the 15+% increase in the market that we've seen over that 1-year time period. But all the asset classes are accretive, adding value. And then on the very right-hand side under MS, you can see the asset classes that are adding alpha on asset class basis. Non-US equity, fixed income, real estate, real return are probably the standouts there. And then private equity and the US equity market maybe struggle a little bit more on a relative basis, although make the argument that given the objectives that you have for US equity and sort of being mindful in general of being late cycle, wanting to have lower beta, being positioned more defensively, these numbers make sense.
On that private equity number, we'll take a look at that in the tech report. It's a benchmark issue, not a portfolio issue. We'll take a look at that in a second.
Okay. Scott?
Just real briefly, under the US small mid-cap equity rate, and we've talked about this before, that the Don Smith and Company group, how long do we continue to ride with someone like that? It's been 5 years, and I realize you have to, this isn't something that we should do every 6 months, but it's been 5 years, which is, to me, is a long enough period. I mean, their performance is just terrible. How long do we stay with someone like that before we, reinvest someplace else?
Start out to talk about that every week, don't we? Start.
Yes,
Why
we
don't you
do,
go ahead?
And I feel bad because I think I was on the RFP committee that selected these guys. Full disclosure.
Yeah, it's a toughie. Donald Smith has a unique strategy. It's based on price to tangible book value, which means the value of their, it's about 0.8. What this means is that if the companies in their portfolio did nothing but sell the assets, they would make 20 cents on the dollar. So this is how deep a value stocks they buy. And, it's just been a long period where value has underperformed growth. So you compound that with the deep value of Donald Smith, and it's, it's at the extreme. That's why we are where we are. I just think it would be the worst time in the world to give up on a Donald Smith. I think our strategy is to try to give them a full cycle and then evaluate, and we might find that they outperform or underperform, but either way we might not like the track mirror that they cause the portfolio. So
Yes, Scott, I think we've got managers in the portfolio that you'll almost always find are contemporaneous with whatever's going on. So the BlackRock strategy, right? That quant. Those guys turn that portfolio over. You always have current, very, very current information, what's going on in the market, a lot more momentum driven. You'll see that manager rarely get behind the benchmark, and if they do, not by very much at all. There's a continuum, and out the other end, sort of Donald Smith. That's a full cycle manager. You've got to get those guys a full cycle to see what they can do. Now, Cortina was another full cycle manager, and that one they just got outside of bounds, and we let that go. Is Donald Smith in the same boat? I don't think we've come to that conclusion yet, but we're wondering.
How much longer is roughly for us to complete a full cycle? We're talking. I realize I don't have crystal ball here.
Yeah, peak to trough to peak, Scott. So it's just you can't say a time, but it's just it's peak to trough to peak. So we were at the bottom in March 2009. When will we get back to the bottom? Yeah, it's.
One of our issues is, with these full cycle investments, and we've got quite a few. There's some in the private portfolios also. Is we're almost at the longest cycle ever. I mean, a couple more quarters, and we are the longest cycle we've ever had in the country. So that's part of the issue with some of these full cycle type managers.
So I know it's not particularly relevant, but what is the fee that we've paid Donald Smith for this wonderful performance? It's
most less.
Well, we're probably don't want to get into
Okay.
too much discussion, but we are seeking several fee reductions, in negotiation right now. In several managers.
All right, good.
In response to a question, I don't know, whether it was at an investment committee or at a council meeting, I remember I kind of asked Vince the same kind of question that Scott just asked. And Vince, I remember you telling us that, my question basically, or the question on the table was, when do you decide to make the change? When do you decide to switch? And your comment was, you look at strategy and execution. If the strategy is out of favor, but the execution is still good, you tend to stay with them. If the strategy is good and the execution is a little shaky, you still tend to stay with them. But when both of those are down, you get out. So where's Donald Smith in that panel?
We see the first group, Harold, I would anyway, certainly be a little different. And that's the net that Cortina got caught in.
Both.
Yes, and I don't think we're there with Donald Smith. I think, we go through a recession with those guys and they'll put up some very, very good numbers, at least relative numbers. A lot of performance will come back. That's my anticipation. But I think as Scott was pointing out, when's that gonna be?
I just have to ask Harold how that relates to Lobo Athletics.
Oh, thank you very much.
But we can talk later.
That's okay. If you have what I'm wearing today, it's okay.
It's a long cycle.
That cycle's 108 years and that's impossible to break into the thing. I don't think I'll be here for the next 108.
So I think that wraps the comments on this, if you have any
Right.
questions. So if you don't mind, in front of you is the touch report. We've been showing you a lot of different peer numbers because we did a lot of different peer numbers, so we tend to share them with you. Last month, we showed you the investment force numbers that the LSC uses in their report on the three investing agents. Just a reminder, those were sort of across the board, pretty much 40th percentile, the top third, where we were riding, but slightly wrong, but Land Grant was roughly 1/3, or top third of that, so top 40th percentile. These numbers tend to be lower than the IFX by 10 to 20 percentage points, or 10 to 20 rank points. And we did a big study, not a big one, but we did a study for the investment committee to discuss why that was. Primarily, it's the way that we calculate our gross performance, because this database is a gross database. We only have about a 20 basis point spread between our gross and net. We know our fees are greater than 20 basis points, and it's just the way that we calculate what we call gross and that's what we call net, which is a true net. So we tend to suffer in the gross databases because our gross number is very conservatively calculated. So if you sort of take that 10, 15, 20 ranking points, this matches the IFX. We think we're performing well relative to the peers on both gross and net. You see that we're back to about average here in this report. That's on page 4, kind of across the board for Land Grant. I mentioned I would talk just a little bit about private equity. If you flip to 10 and take a look at the Cambridge PE 1/4 lag, it's the bottom line, the green A. So you see the benchmarks in the top, between the top quartile and the top decile against the peer group. So there's 21 funds in here, out to 7 years. There's 32 funds, 30 funds for the 1 year. You see our performance is the total private equity line, X cash is in the top quartile for the top third of performance relative to other folks that build portfolios like us. But that negative that you saw on page 320 in your book, at minus 36 basis points, that's that benchmark sitting there in the top decile, beating up on everybody. We've got new systems in place. In fact, we proved it last month, and we're hoping that we may be able to construct a custom index out of the information that's in those. So that would be a lot closer to what folks out in the market are actually doing, and not what this benchmark is reflecting. Otherwise, very good performance across the asset classes. We flip to let's see, page Yeah, page 7 is US equity. We're lagging benchmarks there, as you saw in the performance report, but you can see we're median or better against other folks that build portfolios the same as we do in the US equity space. If you flip the page to non-US equity, you can see sort of top third, top quartile performance there in the near term here since we restructured that portfolio. Fixed income is just off the charts, top decile, #1 last year. We think this is more of a comparison issue. We turn in our entire fixed income returns, and we think many of the peers just turn in their core. So at this point in the cycle, and this sort of point in the market cycle, we should be doing very, very well, as credit is doing quite well. These numbers will flip when we hit a recession and credit starts to widen out. So it's really a comparison issue, but still, I think even if you adjusted, even if we just showed our core numbers, but you can kind of see our core plus pool is the closest, and that's sort of top quartile type numbers. We think it's performing well, also of course. We look at private equity. The last one is page 11. That's real estate, and you've got mostly top quartile performance there. So real good asset class performance from just about every place that we invest.
Liz, I think it might be worth repeating what we discussed in our last couple of investment committee meetings we touched on in our last council meeting about these various peer benchmarks and how difficult the comparison is. One might even say unreliable, given the fee treatment.
We try not to highlight this comparison very much to you. We think you should know. Other people do look at it. Like I say, the LFC uses a similar database to this to make measurements. So we want to show it to you. We try not to highlight it to you. The thing that drives at the top line, the total fund numbers, the thing that drives that is the performance of the various markets against the long run expectations that we use to build our asset allocation. So for instance, 2017, stocks were up 25%. Our long run expectation for that asset class is 7%. So to the degree that we're overweight or underweight relative to the peer group in US equity, and we're slightly underweight, it lowers our ranking. But it's just for that short period of time, and if our long run assumptions are correct, that performance will come back to us at some point. So what really moves your numbers around in all of these, whether you're using the IFX or TUX or RBK's numbers, is what's happening with performance, short-term performance of various markets relative to our long run assumptions that we use to build the asset allocation times our sort of relative weights. Now, you'll notice one report or one page that Marcia and Matthias always highlight for you in their executive summary is the one that has the dots and they're all spread out on the chart. You can see how we've come closer together. We've taken a lot of the risk versus the peers out with the more diversified asset allocation. So you'll never really see us in the bottom quartile or in the top quartile, not very often at the total fund level. The other thing Lynn was talking about also is that gross versus net spread. We have more private investments than the average fund does in these universes, and all of our private investments are marked as net in our gross number. So that works against us. And then we think there's some funds that actually report full gross. So they gross up their private investments and they put full gross numbers into these databases. So in two ways, we tend to be disadvantaged against the gross. So we keep our eye pretty close on the investor force, which is the net database. And that we perform, as I said, 10 to 20 places better than in these gross.
So as we think about key metrics over time, we're really gravitating more towards the likelihood of meeting our return assumptions.
Right, we need to hit your 7. That's the most important thing. We need to do it in an efficient manner, and that would be the alpha line, the outperformance line relative to the policy benchmark. Those two things, that's the important measures.
Okay, any other questions? The next item is probably informational only. I don't think we need to discuss. That's the private equity. Unless there are questions, I will move on. Okay, Steve, your report.
Thank you, Peter. As we always report, the total distributions over the past 12 months, 916.7 million.
August?
That is through August, correct. West Texas Intermediate, yesterday was at $72.28. A lot of you have been reading about the discount that New Mexico takes. Duffy's here, Dawn is here, from LFC, from DFA. That if you want to discuss that, what are we averaging now, about $10?
About 13.
$13.
Did it go up again? It's more now. Sorry, Donnie Lacius with LSC. We're at about $53 right now for New Mexico, which puts us at about a 17-18 variable discount at the moment. We do expect that to stay high and go up in the short term, and then as pipeline capacity comes on, for that to drop off really quickly.
And this is the infrastructure cost associated with our oil?
Right.
So if the state would adjust money in roads and pipelines, we would get better prices for oil?
Well, we have 3 pipelines in the making, 2 that are supposed to come this year and then 1 next year, so.
Okay. So
That will drive that difference.
Net asset value, as of this morning is 24.4 billion. And then if you will, take a look at the sheet I give you each month, and you'll see that we have highlighted in yellow the $10.38 billion number, which is the growth in net asset value since April of 2010. We then highlight down below that total distributions over that same time period of $6.23 billion. So if you combine those two, that's about $16.6 billion of value add, I would call it, from increased net asset value and increased distributions, or total distributions. Sometimes endowments analyze their contribution by combining those two numbers. We don't traditionally do that, but I thought it would be worth mentioning. The other number that is relevant and that perhaps we should have highlighted is down under C, which is the land grant inflows from the state land office in August of $73 million, just about 1 million less than the all-time high back in October of 2014. And of course, those inflows do impact the net asset value. Since fiscal year 15, the average annual distribution growth has been about $65 million a year. We at times call that new money. And I think that's worth keeping in mind. Down under council matters, as we always do, I'll give you the meeting dates for next month. Under operations, David, would you introduce Consuelo, please?
Absolutely. This is Consuelo Annan, our new network administrator. Hi.
You're a very important person.
Try to be good at what I do.
We're very pleased to have Consuelo with us. Thank you. In just a moment, Brent will introduce a guest that we have, and we'll let Brent handle that. We are looking for a new public equity analyst. Maria Korostolev is being transferred along with her husband out of this market, and I believe going to Texas. Is that right, Starla?
Correct.
And Starla's in the process of recruiting a new person. Carrie's working on finding a new administrative assistant for us. Terry, who was at our front desk, is now going to work for Sandia National Labs. And we wished her well. She's been very helpful to us during the time she was here. We did look at the land grant inflows from the state land office. I think it's also interesting to think for a minute about federal minerals. Let's think about BLM minerals, Bureau of Land Management. We saw a record $972 million generated from the September BLM lease sale. Somewhere between 48 and 50% of that comes to New Mexico, depending on how you analyze it. That is the percentage of bonuses that are paid for the federal leases, and it's also true of the royalties. It's also interesting to juxtapose the royalty inflows that we realize from state minerals against those that we realize from federal minerals. The state mineral royalties come to the land grant fund. The mineral royalties go to the general fund from the BLM lands. So I think that is interesting to know how that came about. I don't think any of us are quite sure. We weren't around at the time those decisions were made. But the general fund is receiving all the monies from the BLM lease sale.
What are the principal minerals that are driving those?
Oil and gas, oil.
So we're not talking about sapphires or anything.
Oh, no. No, but we hope to.
So what about other minerals?
Coal, uranium, potash.
The hard rock minerals
Potash?
produce a lot less than oil. Gas produces a lot less than oil, but oil and gas are the primary drivers. Is that correct, Debbie? Under external relations, a few interesting things for you. Charlie and I were invited by Representative Jim White to join the Bernalillo County Republican Party on the 14th. We had an excellent turnout, very engaged, and enjoyed being with those folks. Thursday of this week, we'll have a smaller group. I'll be presenting to the Santa Rosa Rotary, and looking forward to that. Their school superintendent will be there. Representative George Dodge, who is the county manager, is going to be at the LFC meeting. And he said that Dawn would not allow that meeting to be moved to Santa Rosa that day. Come on, Dawn. Vince and Paul presented very well to the Southwest Institutional Investment Forum, Investor Forum, on the 20th here in Santa Fe. We had a very good turnout for that, and it was good to be able to host that here. Vince, do you have any comments on it?
This is a conference I've been going to for several years. They do a really good job of getting public fund investors to come out. I've been going to, they do it by region in the country. I've been going up to the Rocky Mountain conference. I've got a lot of friends in the funds up there, and they all come to this conference. So a couple of years ago, they or I guess this was the fourth year, so three years ago, they started the Southwest for New Mexico, Arizona, Utah, and Nevada. And they've been having it in Scottsdale. We've been talking with them, how about coming over to Santa Fe? And last year, they almost pulled the trigger. In fact, they actually had printed up the brochure that said they were coming to Santa Fe, and then they changed their mind and stayed in Scottsdale. But they came here this year. They doubled the number of participants over what they were getting in Scottsdale. And they had two sponsors, one of which, the two that put it on, were communicating with me after the fact. One of which said it was the best conference you've been to. So this was a place for them this year, and I think we'll be back next year to see if they can get more to say.
Did we participate in the construction of that?
No, just encouraging them to come to Santa Fe, since we were one of the states in their region.
Right.
And talking to folks about kind of
Where was the physical location of the conference itself?
They did it at Hilton down here on San Juan.
And the Hilton did a nice job. We'll be in Los Alamos presenting on the 13th of November. And as we go to these various venues, we're taking our 60th anniversary report and handing this out to people. And it has been really well received. Vince will be joining the Santa Fe Community Foundation Board of Directors in October, and will also be chairing the investment committee.
So we'll watch their investment performance.
Well,
They're not quite as
Aggressive.
Theirs is higher than ours, we're gonna start asking questions.
we should. They're very risky groups.
We encourage our staff to be active in the state and the community, so long as it doesn't interfere with what they do for the SIC. And certainly this is a contribution that doesn't interfere with what we do. We appreciate Vince doing that. We have been discussing how the Tax Stabilization Reserve Fund, also known as the Rainy Day Fund, will be invested. And as the statute currently provides, those funds will be invested at the state treasury. Question whether it would be wise to invest some or all of that money with the SIC over a longer term to try to achieve a better return. So we will be discussing that with you prior to the legislative session to see what your thoughts are. And if you believe that we should encourage a change in the statute, we'll pursue that for you.
On that note, Steve, is it accurate? I'm not real familiar with the Treasury Department as a whole, but don't they invest primarily on a 30-day basis?
Yeah.
And just a 30-day basis?
Overnight cash, but
That's
one basis point or something.
Yeah, I would agree, that needs to be looked at, that's way too short of a duration.
And the estimated amount that might flow into that fund this year, Duffy, is a range of what?
About 137 to 175 million.
Who would be our client, DFA?
No, it would be the fund. It's just like water, trust, or tobacco.
I think, why wouldn't we go for it, as long as we
I
can
don't know.
identify a
I don't know
client?
why we have a decision to make. I think it's really the state.
Leave a lot of money on the table.
Well, the state is,
Yes.
I guess if we felt it was a good thing for us to recommend, perhaps there would be a couple of legislators that would like to sponsor it. We certainly would be supportive.
If that's gonna be the case, I think we ought to think about having a government, you mentioned this the other day, a legislative working group. Somehow, if we're gonna be pushing something like that, we ought to have some of us working on it, some of the council members working on it. It's my opinion.
We disbanded that committee, said, of course, we could reband it if there was a clear and pressing need.
Dawn has offered to get together with us to discuss this in more depth. We will do that, and whether we will advocate or not is uncertain. We'll see.
I would almost prefer for us not to advocate for that because our role is not fundraising into our assets. And I think that is a position that we should not promote, that we are fundraising through the legislature.
I would differ with that opinion. That is that it's all about doing the best we can for the state. And for the, and if they're making 1% or less with this money, I think we can do better than that.
That's all close to 1%.
Yeah.
Close to
A
1/10 basis.
Oh, yeah, 1/10 of 1%, excuse me. I think it ought to be something to look
I
at.
think what from my perspective, I think we would encourage an educational process that shows some of the stability of the pools that we can offer. So obviously, if they go into a private equity pool, that isn't gonna work. but some of our longer-term, more stable pools have worked well for many of our clients. We can show a performance track record. And then it's up to, I guess, the legislature to choose what they want to do. I'm sure you should be able to show some numbers that make that decision.
Yeah, I agree with that, Peter, and on the point of identifying the client, we've had this discussion on other funds. We need somebody identified in whatever decision the legislature makes to give us their advice or concurrence on this allocation.
Choose pool.
Liquidity, so.
Oh, you know, the portfolios that you oversee are about a 12 volatility is the risk level of those. I just sort of stick a finger in the air as to what sort of risk people might feel comfortable with. It occurs to me maybe 6 or 8, percent is half of what you're doing now. That would let us put 200 to 400 basis points over what short-term investments would be able to do annually with some fairly low risk. 6 or 8 balls pretty low. But I need to sit and talk to these guys and maybe put some stuff together for Legion with the dog later.
On that same note, so we have the same issue at Eastern, we're one of the clients here. Actually, this is an interesting conversation because we have funds with the treasurer's office and we're seeking some help from some advisors to move it to garner a higher return and avoid as much risk as possible. Is that type of thing available to us through the SIC as one of your investors, or do you tend to stay away from that sort of advisory service if one wants to call it that? I'm guessing you don't get into that, but I'm just asking the question because we're here.
I'm at a conference right now. No, we are not registered investment advisors. We don't provide advisory services. And the reason we don't is theoretically, you would be taking on a potential liability on behalf of the fund and the beneficiaries. And since our first duty or our only duty is to those beneficiaries and our clients who participate in the pools, I try and dissuade.
Yeah, firewall there.
I mean, I think we speak up and help our clients if we see something crazy and all equity or something, but we really try and not put on the advisory hat. One, we're not RIAs, and 2, there's a liability to the permanent funds theoretically. I'm not sure.
That's what I expect.
I wouldn't want to consider that.
But some of our consultants and advisors could be construed as helpful to.
Or they can hire their own consultant.
Well, they can,
yes.
Right.
That's why we went the way we've done. This is a recent event. I expected that would be the answer, but I'm just curious.
Do you have an investment consultant that works with the university?
Not on a formal basis. We haven't had that need in the past, but it's something that we're a small campus, and I think there's probably a lot of universities, the smaller type in the state, that don't have any of that expertise in-house. So I'm not pushing for what you said is very clear, but yeah, there needs to be something like that that just doesn't exist on most campuses.
Why can't you be a client?
We are
You
here,
are, okay.
but not for the short-term treasury type
Oh, I
stuff
see.
isn't what we have, or that's what the treasurer's office. So I understand their role to be conservative and not have any risk, but as we're talking about with this fund here, we're leaving money on the table.
So does that mean that we need a product that we can maybe constitute that would be an offering to these kinds of situations?
I don't think we're gonna call it a product or an offering, but maybe.
No products and no offering, however, a rule that is constituted in such a way that it might be attractive for not overnight money, but money that was short term.
Well, we face regulatory, issues that was sliding out, we need to wall off, liability. Those two things together are pretty big, really lead us to just offering the pools. But continue to think about it.
Thank you, Steve. Brent?
Just 3 things, very quickly. I'm sure all of you know that we have a new audit firm this year, and it's Moss Adams. Today we have Aaron Hamilton, who's the senior manager at Moss Adams, joining the meeting. I suggested to him some time ago, no matter what I tell him or what he reads as far as minutes are concerned, there's nothing like
Very good, thank you very much. Governance?
Nada?
That's great, I love that report. Any old or new business? Then a motion to adjourn.
So move.
Okay, we are adjourned, thank you so much. Great meeting.
You're